they've just they just remember 10 years, 20 years of desolation. They remember the peak of all these people losing money buying at the peak. But if you're being objective and look at the chart, it's a cycle that restarted in 2003, and you should have loaded the boat. Long-term meaningful trend. These are the opportunities of once in a lifetime to buy in 2003 gold.
Yeah, Patrick, I think this is so interesting because I think we're speaking to two kind of audiences here. Obviously, there's the stacker, and I know you went on Wall Street Silver recently, and you know a stacker is looking at this as an opportunity to buy. Now, obviously, you're also dealing with maybe a hedge fund manager. You're dealing with people who are looking at the paper markets, essentially the paper markets, which are, so yes, if you've got, or you may need to know when to hedge or to unhinge your hedges. So it's interesting in that respect because, and I think what we're talking about here, obviously as a stacker, I mean, come on, you just average in and you're a winner. And I think, that's the ultimate game. We all know that there's so much paper market dilution or money printing that ultimately the only real money is, of course, physical gold, physical silver. Has been around for 6,000 years. But I think what's interesting is here, because I'm looking at this, and we deal with people very much that would look at these charts. And what it is, because the people are siloed into, a lot of US-centric traders are siloed into the COMEX, the casino as we call it. And it's no surprise that it is a casino because for example, I had to get rid of all my clients in 2013 that were US-centric simply because they were cut off from trading the over-the-counter markets. And so they were siloed into the COMEX. So now it's become like this siloed thing where you obviously, these moving averages charts that they're showing up are actionable points, and it's interesting. So yeah, please expand on because I get what you're saying.
Well, so I'm going to zoom in right now. We're going to go to the gold chart, and there's a nice concept to measure. I found a way because I'm an emotional person, and I always, as a technical analysis, I try to find tools which are going to help me situate my emotions versus the reality. So the further you are away from a moving average, the more the emotion's high. And I could have probably put, here I have the gold chart, like where it's written minimal target 3550. But at the bottom pane, that's the distance from the 16-year moving average. So essentially, since 1967, every time gold has went ballistic, you could see that by it distancing its moving average at a ever increasing pace. And all the headline news like death of the U.S. equities like in the 1980s, that was a going motto. That if I would have looked at that chart, I would have said, "Oh my God, I'm so stretched from the moving average." Of course, people think the U.S. equities can go nowhere, and gold's like the ultimate thing that's going to go to a million, right? But as a chart trader, you should realize that you're so deviated from the mean, from the average, that eventually the human emotions of greed, where you think something's going to go on forever, it reverts, right? And then there's a correction to the downside. And if there's a paradigm shift in the macros, then you could have a longer consolidation. But look at that. Look in 2000, right here, 2003, the distance from the 16-year moving average was from below zero going above zero. And that's very bullish in TA when something is negative, where nobody wants it, and it starts showing relative strength. It refuses to go lower and decides, hey, I'm going to stay above this long-term meaningful moving average. But remember, I don't know if you remember this, but I've read that in the late 2000s, I think UK, they got rid of all their gold. I think Canada also around that time, they sold at the bottom. Even I think in the Barron, it says the death of gold. Gold is a weight paperweight. Is that how you say it?
Yes.
But you hear those things, but then as a chart trader, when there's rampant fear and it says gold, what are you doing with that? Because people are living in the past, Andrew. They just remember 10 years, 20 years of desolation. They remember the peak of all these people losing money buying at the peak. But if you're being objective and look at the chart, it's a cycle that restarted in 2003, and you should have loaded the boat. Long-term meaningful trend. These are the opportunities of once in a lifetime to buy in 2003 gold. And then again, you see it rolled up. It got stretched away from its 16-year moving average. And I put some circles where previously it hit some resistance. And what happened after that? A small blow off top, and then it went back in hibernation. But here's the new opportunity right now. We're creating higher lows on the distance from that 16-year moving average. And there's a clear pivot line or breakout line, where a pivot line in TA is lines, guys, is the most it gets tested from above or below. It becomes meaningful. The market's reacting to that line. So you got to pay attention to it. Look, we're right below it. So the bull run for gold has not even started. It's practically hasn't started, Andrew. It's crazy. The momentum's trying to carve out a higher low right here. And I'm pretty sure that once we close above that 71% above that 16-year moving average, we're going to have fireworks, because there's another concept in TA called reverse symmetry moves. So the faster it goes down, there's not a lot of buyers on the way down. So on the way back up, there's not that many bag holders in strong moves going down, right? So it kind of creates a vacuum. There's going to be a crazy move where gold's going to expand from 71% above its moving average all the way to 175%. I think without even blinking an eye, it's just gonna vacuum up, just like it did in the mid 70s. That pause, you see how it went down fast. As soon as it got back above this line here, it just rocketed up and overshot. And even from 1983, we did a reverse symmetry move. Even it's 30, 40 years later, it doesn't matter. Fast down, fast up. And this is a setup, Andrew. So when I see that, stackers, good for you. You're buying super cheap right now. And traders, if you had a chance to play this gold market, swing traders or position traders, look at that. When you're coiled close to that 16-year moving average, these opportunities, they don't happen that often, guys. They happen once here. Here we crossed above. In 2018, that was the last chance, the last greatest chance. And now we're having another opportunity for gold. It's crazy.